Hardly any of us can purchase a new home without it having a big effect on our finances. I'd like to introduce Jane McNamara, the President and CEO of GreenPath Debt Solutions, a not-for-profit organization that helps people enjoy a better quality of life through financial counseling, education, and also by offering solutions to help individuals and families plan for their future. She's going to talk about the importance of budgeting when you're getting ready to buy a new home.
Often, our clients are people who decided to buy a home but didn't take the most important step first. Just as with any major financial decision you make, when you're buying a new home, you have to have a plan. A vital part of that plan is budgeting, but there are more elements to creating a home buying budget than most people think. You don't just budget your money, you need to budget your time and your effort too. A carefully developed game plan will help you do things in the right order. You'll know if you're on track, and you can recognize and deal with a possible problem before it gets out of hand. A timeline is also an important part of your overall budgeting, so you know when things need to be done and whether you're on schedule. You'll want to review the budget and plan regularly to see if there's something that needs to be revised to allow for unexpected events. I've asked some people who are professionals in various areas of home buying to give us their perspectives.
If you're considering buying a home, it's important to know what your budget is and to have money saved. That's a paramount. That way, that's going to help set up a timeline for you as to when you'll be able to actually start looking for a home.
When you think about the expenses that you have with the home when you're going to be purchasing it, you need to think about both the upfront expenses as well as the ongoing expenses.
The budget and timeline should be evaluated on a continuous basis. People's situations are continuously changing, so they're constantly going to want to monitor their situation to help them determine what they can afford on a monthly basis and also determine whether the timeline they have is still accurate and reflects what they're capable of doing.
So when I look at buying a home, it's important to have a game plan. Even when I look at my work that I do as a chief financial officer with small and mid-sized companies, the exact same thing applies with them. You need to make sure that you've looked at all of the different facets ahead of time so that you don't miss anything when everything is said and done. For example, there are going to be more homes that are available on the market in the summer months. As well as if you have children, I would make sure that you consider that you've thought about their schooling and when they're going to be going into school so that you're in the home at the right time.
Working with a housing counselor can help you prepare for purchasing a new home. It can help you put the timeline together, looking at your budget, looking at the money that you may need to save for the down payment, for the closing costs, for the things that you might want to do immediately in that new home, as well as looking at how long it may take you to sell a home that you're in now if you need to sell that home and use the proceeds for the new home.
It's very important to budget when it's time to buy a house because you want to make sure that you can fully enjoy the house. It's nothing like having the biggest house on the block but not being able to enjoy it, not being able to have heat when it's cold or air when it's hot. And you want to make sure that you don't lose the house because you'd rather be able to buy a house that you can afford than being removed from a house that you can't afford.
As our expert said, the first question you need to ask and the most important consideration is how much house can I afford? That's not as easy to answer as many people think. Here's why.
Well, the basic qualifiers for a mortgage for a new home buyer is several factors. There is first and foremost the credit report and the credit score. There are the debt-to-income ratios that the bank will calculate, and that's based on a variety of things, your income compared to the mortgage amount as well as your total debt. There's also your net worth, the amount of down payment that you may have for that particular mortgage, and those factors.
Other considerations are the size of the down payment, interest rates, fixed or variable. It's very important for the borrower to understand and really realize what size of mortgage payment they can afford to make. When considering interest rates, it's important to understand whether you're going to have a fixed interest rate or a variable interest rate. Fixed interest rates are basically set for the 30-year term of the loan. Where a variable rate, the rate is fixed for only a short period of time and then may adjust as much as annually after that. So therefore, it's very important for the borrower to understand exactly how much of a payment they can afford to make today and down the road.
Here's more on that same subject.
When a borrower hears the term PITI, the lender is referring to principal, interest, taxes, and insurance. The principal and interest cover the loan payment. The taxes are the property taxes on the home, and the insurance is the homeowner's insurance. Therefore, it's very important that the borrower understand that there's more components than just the principal and interest when they're considering how much of a payment they can afford. They have to also consider the taxes and insurance, which are a component of that total housing expense.
As you can see, there are many things to consider in buying a house. Some you can plan for, others you can't. That's why, with our clients, we stress budgeting to buy. Let's look at some of the things you should be budgeting for.
One of the biggest mistakes that I think people make is in shopping for a house and then trying to make the budget fit with the house. What they should do instead is figure out what their budget is and find a house that fits within the budget.
I would make sure that I knew that I could afford the payments that are going to be required ongoing. So you're going to have, in those monthly payments, you're going to have both the payment for the house as well as insurance and taxes. I would also encourage you, when you think about that, to think about making sure that you've saved off enough money for the house to be able to make upgrades and keep it clean and be able to fix things and do repairs as ongoing, because those costs will always exist whether we plan for it or not.
Some of the things you want to think about budget-wise when you're purchasing a home, not only the down payment for a mortgage, how much will it cost you to move? What do you want to change immediately when you get into the home? Colors, at least, maybe. Also, you don't want to drain your emergency fund. You want to have something still there because emergencies still do happen.
I would make sure that I have enough of a safety net behind me. And when I think about a safety net, I would think about having 2 to 3 months of your expenses saved so that it's accessible in case something happens and you aren't able to make those payments as easily. That way you'll have enough money there and available.
There's a lot to think about and consider. Fortunately, there are professionals like the ones you've seen who can make home buying much easier. Here are some suggestions for who to talk to.
So if I were looking to figure out what my budget should be, I would look for some trusted advisors. First, I would go and I would see if I could find some not-for-profits that are out there to help people with their budgets. In addition to that, I would look at my own trusted advisors. When I think of that, I think of, say, my CPA or my financial advisor, my banker or lender. And all of these people that you're looking at should be a trusted advisor, somebody that comes with good recommendations from people that you know.
If you don't budget properly when it's time to buy a house, there can be a lot of consequences. On one end of the spectrum, you've got the person who can afford the mortgage payment, but they can't afford anything else that goes with the house. So they may have this wonderful house in a nice neighborhood, but they can't afford to turn the electricity on. Or when their friends come over, they have to sit on the floor because the person can't afford to buy chairs for the house. So you have to keep in mind that a house is more than just the principal. It's the interest and the insurance and the utilities and the furniture and the repairs. There are a lot of things to consider. On the other end of the spectrum, you've got the person who can't afford the things that go along with the house, nor can they afford the house itself. And that can be quite unfortunate because you could lose the house. And no matter how much you beg and plead, the mortgage company will take your house if you don't pay the bills.
From our perspective at GreenPath, home ownership, as important as it is only one part of your overall financial health. Just as with buying a home, you need to make sound decisions in managing all your finances. That includes setting realistic goals, budgeting carefully, using credit wisely, and saving and investing regularly. Fortunately, there are a wide variety of professionals who can give you advice and help you take the right steps to financial freedom.
There are many things you need to consider when you set out to buy a new home. For example, here's how qualifying ratios can affect your ability to borrow money. All lenders have parameters for how much income should be allowed for housing expense and for total debt to income ratio. These qualifying ratios vary, but we'll use typical ones, 33 and 38%. The 33% is the amount of monthly income allowed for the total housing expense. The 38% includes the housing expense plus all other long-term monthly debts. For example, a $40,000 yearly gross income works out to about $3,300 gross income per month. The amount allowed for housing is $3,300 multiplied by 33%. That's $1,100. The amount allowed for total debt is the same $3,300 multiplied by 38%. That's approximately $1,300. When we subtract the $1,100 from the $1,300, that only leaves about $200 a month for other debt. If there's debt payments greater than the $200, the lender may not be willing to loan enough to buy the house. Using the same formula, it's possible to estimate qualifying ratios on any gross income. Thanks for tuning in. We'll see you next time.